We are live on Instagram and we are live on Facebook. What is up, you guys?
What is up?
Happy Talk About It Tuesday, where we, SK Ren, your real estate friends, are coming to you live to talk.
What up, Nate?
All things.
Yes, all things real estate. Actually, everything.
It's just all things.
Yeah.
It's all things, but tonight in particular, hold on, let me share it so I can make sure that we are live. Uh-oh.
Hey, what's up, buddy? We miss you.
Nate, how is the little man?
How's little Liam doing?
Oh, okay, I see that we're live. Let me just share this really quick. And we'll be off. Wait. Okay, so babe, tell them what we're talking about tonight.
Yes, today we are talking about refinancing. Who's it for? Is it a good idea? Is it a bad idea? Certain situations that would make it good or bad. Break-even point. What else?
Who is this video for?
It's for everyone that owns a home. What's up, Caitlin?
Mike Doyle.
Caitlin, how was your dinner?
All right.
What up, Mikey?
Trying to get this to share. Having a little bit of a hard time sharing it.
Oh, maybe we could share it later.
Okay.
After the.
Okay.
Let's see.
What's up, guys?
Brad.
Oh, Brad Flanagan wants to be in your video.
Oh, wow. Look at that.
Does he really? You guys, tonight, Brad Flanagan is coming on. Send invite. Instagram, we're not going to be able to see Brad on Instagram.
But you will be able to hear him.
You will be able to hear him, hopefully. And we're gonna put these together. So anyways, if you're on Instagram right now and you want to really get the lowdown on refinancing and listen to what Brad has to say, I would highly recommend jumping over to
Facebook.
And you can find the video, this live, on our SK
YouTube.
You can find it on YouTube, but you can find it on our SK Ren page.
Oh, and YouTube.
Michael Buckley is on. What's up,
Hey, Michael.
Jake.
Jakers.
So, guys, tonight, this is important. A lot of you guys are watching. I see your names coming up. A lot of you guys own houses, and I'm sure a lot of you guys have been, I don't know if spam is the right word, but a lot of you guys have been spammed on, probably getting spammed on, do you refinance or not?
Yeah, I'm sure a lot of banks and people are sending you mail and emails. And
Babe, don't put your feet up there. Hold
it's
on.
time to refinance.
Approve.
Rates are
Approve.
low.
Invite Brad to join your camera. You set the audience to public. Everyone, see your invite. Send invite. Okay, come on now, Brad. God, it's kind of hard to get people on live, you know. There's all the technical stuff.
It's a feat. It's a feat.
It's a feat. So, oh.
What up?
Hey, Brad.
All right, Instagram.
Everyone hop on Facebook.
Everyone hop on Facebook. We're going to sign up. Are we going to sign off on Instagram?
We could sign on. We could keep it on.
All right, we'll keep it on. But if you want to get the full video, hop on over to Facebook at our SK Ren Real Estate page to hear what the man, the myth, and the legend, Brad Flanagan.
Oh my God.
It's so like Brad is so busy these days that I don't even get to see Brad a lot.
Come on, we FaceTime.
We FaceTime. Let me turn you up here so we can hear you fully.
I got
What's going on, Brad? How was Mexico?
It was really good. It was really good. It was long. It gets hard to communicate, you know, with the Wi-Fi and just being in that environment, trying to get to your emails and take the time to set aside. I think I got 20 plus photos of me on the phone posted on social media and got made fun of, picked on, and all that, but worked out all right.
Hey, our clients appreciate it.
Good. We
And
love it. And
it is nice to get away and kind of reset, but it is also nice to come back home to something to work for and work toward too. So we're happy to have you back.
and it's been neat to see how much the business has, I guess, evolved to technology and eliminate the face to face. I still really like the face to face and try to get those in as often as possible. It just seems now we're doing it like on a mass basis or getting together in a group setting, talking principles, and then following up with one-on-one individualized stuff. So interested to see what this next year has to offer. There's a whole lot going on for 2022.
Yeah, everything's becoming virtual, and they're selling virtual land now.
Right?
So
I
one day
just
we'll
can't
all
wrap
go.
my head around it.
Yeah.
I know, it's honestly, it is kind of, it makes me a little anxious thinking
That's gonna
about
be
it.
next week's topic.
Next
Right?
week.
And I heard somebody actually refer to it as like real estate in the metaverse, and I'm like, well, then it's not real estate, it's virtual estate.
Yeah, I like something real, something I can hold on to. But anyways, besides the fact. Okay, we are going to get down to it tonight. We got people on here that own houses, that have worked with you as their lender even, that want to know, what is refinance? What is a refinance? Let's just start there.
It's a redo. I was trying to see if I could see who else was on here. We got seems like 5 loyal people tuned in, and I heard Caitlin was on there. So if you're still on there, what's up? Hey,
We are on, Brad, just so you know, we are live on our Instagram, and then, yeah, we're live on here. But I guess maybe for the people that don't know who you are, although everyone that follows us most probably knows who you are, why don't you give them a little insight?
I am Brad Flanagan with Major Mortgage specifically. Been working with you guys for a long time, and so we just focus on providing financing for residential real estate, anything 4 units or less primarily, and we try to take a comprehensive approach and make sure that when we are originating a loan, that we are taking into account more than just the goal of buying a house. We want to figure out what are the overall financial goals of the household so that we can make sure that we take advantage of any and all little characteristics or customizable terms and have an impact on the overall budget financials of that household. So a little over dramatic, if you will, but I think we've oversimplified it too with the online lending world and trying to eliminate that professional advice or advisor from the process. So it's not just intended to be quick and easy. We want to make it, of course, a good experience, but we want to keep the goals in mind so that you don't have to refinance unless it's absolutely a benefit to you. So to kind of get back to that original question, a refinance to me is like a redo, and we only need to redo something if it's an oops or if plans changed or new opportunities present themselves.
And like you said, I don't mean to cut you off, but and like you said, how you guys get to know the buyer initially and learn about the buyer's goals. Maybe it is a part of the goal that, hey, in a couple years, or if it's a part of the goal to refinance, sometimes refinance is a part of the topic of conversation even before you've closed on it originally.
Right. I got a text today, actually, just shortly after we jumped off the phone, and a gentleman was reaching out about a loan that we did not too terribly long ago, and just thought, oh, is now a good time to explore a refinance, and he's at 2.875. I don't see us getting there really anytime soon, at least in a 30-year again. So I think there's just a ton of information that flows, and if we don't identify those important factors up front, then we might find ourselves refinancing for the wrong reasons. And the thing that keeps coming to mind right now is really that the biggest disservice you could do to yourself is just call and say, what's your rate if I was to refinance? So there's still a lot of missing information, and if somebody can answer that question really quickly, it's not going to be very consultative. It's just either going to keep you on the phone long enough to have that next conversation, or get you off the phone and you never got to pursue something that could have turned out to be a really, really good opportunity.
So basically what you're saying is that if you're in a position to be considering a refinance, maybe you watch this video tonight and you're like, hey, maybe I should check that out. It's going to be a process where it's more than just, hey, what's my rate? It's going to be, you're going to need to know some information to make sure that it is the right decision or for the financial overall goal.
Yeah, far more to analyze. You know, I mean, Sean, you and I have even sat down so many times with spreadsheets, because I think you and I connect on the spreadsheet level. And there's, if you change that rate and it reduces your monthly payment by $200, but all of a sudden now you're paying $200 a month more in interest because you carried your loan back out over 30 years, you just eliminated that benefit all by itself, because that savings in monthly payment is a cash flow savings, but your costs are now increased. So unless we're doing something much better with that $200, like putting it back into the mortgage to reduce the principal, or allocating it to another high interest consumer obligation, then we're not really seeing much of a benefit. And without knowing what's on the credit report, I can't even advise further as to how we can restructure some debt.
So someone like me too, like when you're talking about that, sorry, were you going to say something?
Mm-hmm.
Were you going to say something?
I love that new haircut, by the way.
Oh, should we take a second to appreciate the mullet cut by
Absolutely.
the one and only?
Yeah,
no way, I didn't know that part of it.
Yeah.
It makes it all the better, doesn't it?
Yeah.
Okay, but someone like me, like how you were just saying, like, you know, there's a lot that goes into a refinance. Now, kind of the overall idea, and correct me if I'm wrong, Brad's the mortgage guy, Brad's the refinance guy. I am a real estate agent, not certified to talk about loans, period. But being a homeowner, how my brain used to think about it, I should say, is okay, well, I bought this house at 100,000. Let's do that because it's just easy, right? And now my house is worth 150,000 because I put money into it, whatever. It's been a couple of years. In Omaha, it's been 6 months. I'm just joking. But let's say that now it's worth 150,000. Why would I say that my house is now worth more just so that I can lower my interest rate, but now I'm going to be paying a mortgage for a house that's worth 150 versus a house that's worth 100,000?
So, in essence, how can we leverage benefits from the appreciation of the home? Is that kind of where we're going with it?
I guess, like, yeah, why would someone refinance? I guess that's my question. Like, why would someone refinance?
There should and could be a number of reasons. So, starting with like the forced and probably less desirable reasons is a lot of times people go on a mortgage jointly, whether married or just in a relationship, and things don't go as planned. So now we have to refinance so that we can relieve a party who's not going to live in that house anymore, and the other one's going to retain it. That's a forced situation where the terms really aren't, unfortunately, going to drive the decision. The decision's already been made. Now, how can we make the best of it? If you bought it at the prime and rates were great, you're unfortunately going to suffer a little bit of a loss. Now, my goal is always going to be, how can I turn this around and make it a bigger benefit if you are going to have to suffer an increase in interest rate. So that's like one reason. Second reason could be you have originally entered into let's say an FHA loan, for example, that comes with long-term permanent type mortgage insurance. And if the home has appreciated in value and your credit profile allows for it, we could switch that over to a conventional loan where you no longer are required to have that mortgage insurance. And now, whether or not the terms, like the interest rate, are the same or worse or better, you can reallocate what you were spending on mortgage insurance and maybe have that be a principal reduction. The good news is a lot of those, there's two types of refinances essentially. You have a cash out and a rate and term. A cash out refinance is where you're going to pull equity from the home that exists, whether from amortization, the pay down of the existing loan, and or the appreciation of the home. So now it went up in value, your loan balance is low enough that the parameters allow for cash out refinance, which it will be limited to a certain loan to value based on loan type. But now what can we do with that cash? Can we get rid of other, again, high interest debt is what I turn to first, or high cost debt, meaning one of the strategies or worksheets that I've created to help show the options that a borrower would have is take the balance of a loan, I divide it by 1,000, and now I have that cost per 1,000. Whereas a mortgage only costs a homeowner about $4 to $5 per 1,000. A car can get upwards of like $30 per 1,000. Interest rates, terms, all that stuff is something to take into consideration. But now, if I can convert a $30 per 1,000 obligation to a $5 per 1,000 obligation, I've saved you $25 for every $1,000 you have outstanding. And now we just want to reallocate that somewhere that's going to make more sense. Sorry, I get into these tangents and I feel like it's a little bit, I don't want to say high level, but it comes faster to me than it does to people who don't do it every day. So ultimately, I try to figure out ways to move the puzzle pieces around so that you can play that game or do that puzzle longer and more enjoyably.
No, it makes sense. And again, for someone that does it every day, it definitely is, it's more in depth than a refinance is more in depth than, what people think, oh, just get a lower interest rate, right?
Which would be your rate and term, where, okay, you still are going to owe about the same unless we roll some costs into it. And now, what are we going to do? Are we going to pull it back out to 30-year mortgage? Are we going to reduce the term or try to customize it and keep it the same? There are certain benefits to shorter terms, like lower interest rates, lower mortgage insurance requirements. There's a lot of different benefits based on the program. Everything is what we call risk-based. So if a lender guarantees you a low rate for 30 years, they're taking on what's called market risk or interest rate risk, also known as prepayment risk, because they're not going to keep that loan for maturity. It's very rare to find anybody today who has a loan for the full 30 years. So by guaranteeing that rate for a long time, as soon as interest rates get better, they're likely to refinance, or somebody's going to sell and then pay that loan off. And now the investor's not realizing that return anymore at the back end of that loan. So that's why there's benefits to the shorter term loans. And then the same thing, I like to look at, on every mortgage statement, you'll see a breakdown of the monthly payment. How much is going to go to principal and how much is going to go to interest. And then there's even the portion that goes to escrow, if you're escrowing. No matter what, that principal and interest total will always equal the same amount because it's based on the original loan amount and the original term and the interest rate. Well, if I'm looking at somebody who did a loan 5 years ago and it was a 30-year, I'm less likely to encourage them to go back into a 30-year unless cash flow savings is the top of their priority list, because again, now carrying out that lower balance over a longer period of time, I'm going to reduce the amount that's allocated to principal and increase the amount that's allocated to interest. So that's the detail that I like to get into, and it's called an amortization schedule. Anybody can Google and find one that will show you. A lot of them have little ads intertwined in there, so you got to try to navigate it carefully and not give too much attention to all those little fancy ads, and then whichever lender or bank is trying to grab your attention. But then you can see that breakdown and determine now what's the best action or the best term to enter into based on my overall goals.
What's the goal? What's the goal? What is the homeowner's goal? And I think that you and your team, like, you guys really, I mean, that's a question. You know, well, what are you going to do with this house in 2 years? Have you thought about it? You know? And I would say that you and your team, you guys really do ask those questions. I guess, like, you know, and two, like the word refinance, I feel like for people that bought their houses 3 years ago, and maybe you've been in this business longer than I have, as far as like mortgages. I mean, refinancing in a shorter amount of time was normally, like you said, to correct something. But now, since the market appreciated so quickly because of the shortage of houses, of inventory that we had, and all the other lower rates, you know, because there were lower rates, people were saying, yes, let's refinance to get a lower rate, right? Now that we see rates going up, and maybe you can talk a little bit about rates and kind of what's going on with that, but now that we kind of are seeing rates start to go up, I feel like, I guess my question is, do you think that refinances will start to shrink as well?
So the forecast has absolutely been that refinances were going to start to dwindle or reduce in volume, because those who were doing it for strictly the cost savings, the interest rate reduction, they've already accomplished their goal. The difference is going to be that homes are still appreciating at a very rapid rate. So now we have this resource essentially that's available to all of us as consumers that could be a benefit, and regardless of, you know, 3.5%, 4.5%, wherever we end up, that's still relatively low. I was watching and doing some research earlier. Back in the 80s, the Fed chair kind of had that same sentiment that we've had recently, where we were hearing from the government that this inflation was transitory, and then all of a sudden it's kind of been realized that it's not transitory, and it's increasing at a very rapid rate. Well, back then it went from interest rates on mortgages from 12% to 18%. And that's huge. I mean, that took years or if not maybe decades to correct, because that inflation got so out of control. So we're at this weird stage, and we have these other factors like health and COVID and things that come up that we can't predict, and we're really subject to the government and what they're going to do, because that's right now, I would say, and a lot of people who nerd out on this kind of information would say that the government today will have a greater impact than maybe ever before on or as of recently, on what market does, what the interest rates do. So that's where it's also important, even when you're purchasing, to be selective, or at least open-minded, to get with somebody who's going to help give you that information. I recently changed my sentiment to, like, I'm not really encouraging clients to buy down their interest rate, because although they're high and they are increasing at a very rapid rate, that you're still going to see advertisements for low rates, but the fees side of things are going to increase to help keep the that interest rate look like it's lower than it really is, even though there's fees that are offsetting it. Well, if I
Which is
do
also
that
another
today,
point too. Like that's also
it
another
is.
point when these people are looking at those like online, get it done, one-stop shop. Hey, click here to refinance. I'll get you a lower rate. One thing that you guys have to be mindful of, if you're watching and you've considered refinancing, is what Brad just said, and it's so important. Even when you go to buy a house, the closing costs. What are they charging you? That is so important. Refinance, they are still going to charge you for working with them, and like Brad said, a lot of the time they have this, it's like, they going to the Cadillac shop, they put the nice brand new Cadillac right out there, and then they go through it and they say, well, this is an upgrade, this is an upgrade, this is an upgrade, this is an upgrade. And what those companies are doing, they're not necessarily upgrades, but they're charging you more, right, Brad, to make that interest rate look lower, but basically just recycling it.
It is. It's meeting the minimum requirements from a disclosure standpoint, and then taking advantage of ways that you can disclose or at least display that information not, unfortunately, it is misleading. And I like to just put it all in front of everyone and say, here's what we can do. Here are the pros and cons of both or either independently. Now, which makes the most sense for you? And so by that time, hopefully we've had enough rapport and gathered enough information. Unfortunately, the process typically goes something like this, where I get a phone call or a text message or an email. This is what I'm curious about. And all I say is just send me your mortgage statement. I'm going to give you an idea of what that looks like if you were strictly to just try to reduce your interest rate or go from a 20-year to a 30-year because you're just not comfortable with that higher payment. Then as long as there's enough interest, I still always warn that you're going to put in an application if you think you are still curious, and then I'm going to give you a recommendation. And it's generally something where I finally have a chance to analyze like what the spending is like. I've had a chance to look at the credit report and see, how much equity do they have in the house, and oftentimes that client might even be interested or at least curious to know, what if I was to sell? I want to refinance to pull money out so I can make improvements, or I want to sell my house. Well, it turns out that you didn't have enough equity to cover all the improvements that you wanted to make, that all the improvements you want to make are going to increase your cost basis or what you have invested in that house to the point where you're going to have to be in it for another 10 years just to allow it to appreciate enough to see a return on it. Let's just get a market analysis, see what it looks like to do some minor updates, make it nice and marketable, get top dollar for it today, and go buy the house that already has what you need. That's the conversation that should be had, but sometimes we're just a little too cautious or fearful as consumers that somebody's going to take advantage or somebody's not going to give us that information.
Well, and I guess that leads me to my
totally.
next question. I feel like a lot of people, like when the rates dropped recently this past year, people were like, "Oh, I'm going to refinance my house, pull out some money and fix up my kitchen or fix up, fix part of the house." What were
Right.
what were some of the issues that you were seeing with that? Well, yeah, that sounds great. You want to pull $50,000 of equity out of your house to put in a new kitchen, but what's the but?
Well, the but is that by the time you're done enjoying that kitchen, trends are changed. Hopefully the appreciation has covered it, and if they didn't have to pull that money out of another investment, all is well. It shouldn't be terrible. The but part for me is that when these refinance booms have taken place, and more recently, it's been in such short periods of time that it actually created what the investors are like Fannie Mae and Freddie Mac. It was called actually the government imposed it to the agencies, and the agencies then passed it on to the lenders, and then the lenders, of course, passed it on to the consumers. So they called it an adverse market refinance fee. So it put another 50 basis points into the back end of interest rates. So in essence, it increased the cost of a refinance by $500 for every 100,000. So we didn't know about it, but everybody got like a stimulus. And then in the back end, if you refinanced, you actually somehow roundabout way have actually paid that back, because the government charged it to the people who back the mortgages. And then of course, the people that back the mortgages charged us as the lenders. And then the lenders, of course, just passed that on to the consumer. And that, to my knowledge, I think it still exists. It hasn't been a hot button because refinance has never been the lion's share of my business. I love to consult on them. They do take a lot of time, and I do enjoy it though, because I can dive deeper with the client. Outside of that, just pulling the equity out of the house, I mean, all it does is preserve capital elsewhere. I would then have to consider, hey, would you have been better off leaving your current mortgage as it is and getting a home equity line of credit? Or, could you, I had a lot of people actually inquired about adding pools. That was a big motivator to refinance
Adding
as of
tools?
lately. And that
Pools.
pools,
Oh, pools.
pools to swim. So
to do what? To make
those,
their properties worth more, or?
no, that's a lifestyle thing, of course. I think most people recognize that today, that you rarely get what you have in cost out of your pool unless you're super handy, have a ton of land, and maybe a backhoe, or you're better versed in those equipments.
Skid steer.
Yeah, we always told forever, like the past, Sean and I have been doing real estate for 7 years. We always told people, never build a pool. Like, and you even too, you and Jamie, Sean and Renata, don't build a pool. You gotta buy a house with a pool. Every dollar you put into your pool, you're not gonna see it. You might see a little bit. Don't ever build a pool. Buy a house with a pool. You want a pool. And what do you know? What do you know?
Well, what I love about what you guys did is you were strategic, and you identified an excellent property to invest in. You used a ton of strategy when you purchased it, and you've grown your business and your other streams of income through that purchase, which is something that is hard to even communicate to the client, but the client that spends the time with you enough to discuss what their plans, goals, needs, wants are, they know it exists. But that's that intangible.
Well, I'll tell you,
that
not
comes from
a lot of clients would be the same mindset of a client that wants to build a nice big fancy pool is not always typically the same client that is okay with shoveling horse shit. So so let me just say that. Okay.
That is a valid point, and definitely something to be considered in the argument. But that's something that you have now in an experience that you can share and then identify, or at least relate with your client and give them that information so that they can make the decision on their own. At the end of the day, that's all that matters, is that the client can make their own decision and has enough information to make it, which is literally with everything that we do. It's just today, the world of real estate, we have to be a little bit creative. We have to be opportunistic. I think that there's definitely shifts going on right now where everything from container houses, 3D printed houses, real estate investments, multifamily, shortages. There's so much going on right now that if you can get connected as a consumer with the professional in the line of work who's got an abundance of experience that's actually more well-rounded, then they hit the jackpot and they accelerate their decision making responsibly, as opposed to maybe not finding the best suited professional for their ventures. I mean, what real estate agents have a session on refinances? It doesn't benefit you really at the end of the day, other than deepening your relationships with your database, with your clients, letting them know that you actually care enough that even when they're not buying or selling their house, you care about the decisions that they're making, which is kind of why I was trying to have a quick phone call with you to make sure that I was staying to topics that were relevant to what you wanted to accomplish today. But it's Talk About It Tuesday.
Brad,
I can't believe I'm here.
We just want your face next to ours. That's it. We don't even
I
care.
get real close. Look at. Hey, screenshot that.
We love having you. I mean, we love having you. You're such a big, you and your team are such a big part of our business. So we respect and really trust what you have to say about everything about loans and mortgages. And I mean, I really did have, before I started doing this, like I had such a small insight as to buying houses, like what is a mortgage payment, what are you paying, principal, interest, and escrow, like those 3 words. I mean, you can ask homeowners today what is in their mortgage, and some of them couldn't tell you. And I feel like
right.
if I wasn't in the industry that I'm in, I probably would be one of those people. So I think it's important to learn about refinance. I know that every single one of our friends, every single one of our clients, everyone that we know has been marketed within the past 6 months to refinance their house if they own their house. Everyone. So I'm really, really happy about what you touched on. I love that you started off this this Talk About It Tuesday, talking about how it's not just click of a button. It's not just like
one size fits all.
It's not one size fits all. It's in depth, it's detailed. There's a lot of things to go over. There's a lot of things to look at, and it's not good for everyone. So
right.
I guess, I'm so sorry. I didn't let Sean talk at all today. I'm sorry.
It's so pretty though.
Oh, he just has to stand here and look good. Babe, is there anything that you want to ask Mr. Mortgage about refinancing?
I think you guys hit some really great points. I thank you for hopping on with us and sharing your knowledge with everyone. And I know everyone will be better off after listening to this video.
My pleasure, sir. I appreciate you having me on. The last thing I would say is we didn't finish that one conversation kind of a little bit about on the purchase side. Hey, what could you do to make sure that you set it up right? We just need to talk about the goals, how long you're going to be there. If you're in the military and you plan on getting transferred, or if you're trying to pursue a job, or somebody's going to go to college somewhere, keep that in mind, because when you are going into a purchase, you're like, I want the lowest payment, lowest cash out of pocket. Well, I have plenty of ideas and potential strategies for that, but they might not be conducive to what's going to happen later on. And there's a pretty strong indication that we will see, despite what everybody hears in the media and all the buzzwords, but if it doesn't get your attention, it didn't accomplish the goal. So be careful about all that stuff that grabs your attention. Today, it wouldn't make sense, at least if it was me, I wouldn't be buying down my rate. I wouldn't be incurring more costs at purchase or a refinance as it stands right now, because there will be another refinance opportunity within the next 24 months. So just that's my,
you think so?
My speculation, my forecast, and I'm not alone in that, and I trust very smart people where I get my information from, and that is currently the outlook. So don't be worried about the Fed talking about raising rates and all that good stuff. That's actually going to contribute to this theory or this forecast. So that's all I got.
Wow, mic drop on that. He wants to end it like that.
Should I drop an AirPod?
Keep us reaching for more. And hey, by the way, I should have said this in the beginning, and I totally forgot to say this throughout this entire thing. But if you're still watching, I still see some people on. If you've watched until the end here, there is going to be a link in the comments below, And if you click on that link, you can sign up. It's just an email, I think your name and your address, or you just plug in your address. And what does it do?
It sends you a valuation of what your current home's worth.
Which
could be helpful.
Could be useful.
Maybe, maybe not.
Could be helpful. Maybe you
Divide
just want
your
to walk
loan.
around and say, hey, what?
Pull up your mortgage statement after you get that report from SK Ren, and then divide your loan balance by your value, and you have what they call the loan to value. If that percentage is generally, if it's below 80 and you're paying mortgage insurance, like that'd be one relevant area for that. It's just good to know, hey, where are you at from an equity position, or how much equity do you have? If you're 80% loan to value, or obviously 20% equity, that 20% of your home value, if it's a $100,000 home, you're $20,000 sitting there. Not all of it's accessible to you, but some of it can be. And then if you have debt on your credit report otherwise, there might be a conversation worth having.
Well, thank you so much, Brad. Thank you, thank you, thank you. We love your brain and all the information that it has in it. And we're happy to have you back in the Los Estados Unidos. And
yes. Next time we better go out together.
Talk About It Tuesday. Next time,
next
we'll
time
be
we'll go
here.
together.
We'll be back in these seats. Brad may or may not be here, unfortunately or fortunately. But next Talk About Tuesday is every Tuesday at 8 o'clock, where we come live to you to talk about all things real estate, life, finances, marriage, and horses.
And haircuts.
And haircuts.
All right, Brad, we'll see you next time. Thank you guys for tuning in.
See you later. See you,
Thank
Brad.
you.